Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Today's topic is income tax, the 2007 returns and preparation of. Our guest is Patricia Catchpole from the H&R Block office on Wolf Road. We're going to start off talking a little bit about some of the things that have changed in the past year and that will affect us in the future, and maybe go on to a couple other things.
How are you, Richard?
I'm doing great. I'm glad you're back.
Thank you. Good to be here again.
That's super. Well, this is getting to be your busy time of year.
It sure is.
And
questions are rolling in.
You've been on other TV shows. And
yes. And a lot of talk this year about some changes, some recent legislative changes. And the one that's gotten, I think, the most press recently has probably been alternative minimum tax.
Okay.
And
let's go into that.
We could talk about that a little bit. Alternative minimum tax is perhaps not the best named tax. People hear about alternative minimum and they say, oh, that sounds good. I'd like that minimum tax. I'd like to pay a minimum amount of tax. And initially people think this is a good thing, but alternative minimum is not.
It's all a question of perspective.
That is correct. Alternative minimum was introduced in the late 1960s because there was a small group, a very small percentage of the tax population that was able to take advantage of certain, we'll call them loopholes, to significantly lower their tax. And Congress said, if your income is high, we are going to limit your ability to use those loopholes to reduce your tax below that of wage earners. And people were not paying any taxes who were extremely wealthy. And alternative minimum went on, and the system of alternative minimum is really like having an alternate tax structure that runs alongside the regular tax structure. And there are certain rules allowed in the regular tax structure and certain rules allowed in the alternative minimum structure. And at its most basic, simplest, and this is a vast oversimplification of alternative minimum.
Right, everybody's got a different situation.
Right, everybody's situation is different, and this is a complex set of rules that you follow doing alternative minimum. But at its bare bones, alternative minimum says, take your income, subtract a larger standard deduction than you would be entitled to in the regular tax system, multiply the answer by 26%, and if that answer is more than your regular tax in the regular tax system, you owe the difference between your regular tax and the alternative minimum tax.
In other words, you owe the alternative minimum.
You owe the
tax.
alternative minimum. Okay. Now, there are a few deductions you're allowed to take in alternative minimum, and when I say a few, this is what applies to the middle class that everybody's getting worried about right now.
Right.
You're allowed to deduct mortgage interest, but not property taxes or state or local income taxes.
So that gets complicated. It really is a separate.
It's a separate
figure it all
tax.
out.
You're allowed to deduct your charitable donations. You're allowed to deduct some of your medical expenses if you deduct them. You are not allowed to take a deduction for dependents. So if you have children, you don't get to deduct the children. You are also not allowed to deduct, you are not allowed to take tax credits. And in the 1960s, there were not a lot of tax credits. In the late 1980s, our tax structure gets changed and tweaked all the time.
Right.
And it was changed and tweaked in the late 1980s. And what happened then is Congress said, we're going to adjust everything for inflation. And the standard deduction will go up a little bit every year for inflation. The personal exemption will go up every year for inflation. The alternative minimum tax did not get this inflation adjustment, and that's why we're having a problem right now. Then in the 90s, something else happened. We started giving tax credits, credits for children, credits for education. There are credits for child care. There are credits for lots of things.
And those are great because they come right off of your taxes.
They come off your taxes. But in the alternative minimum system, you are only allowed to take a credit for foreign taxes paid. You're not allowed to take all of these other credits that have become so popular in the 90s.
Not a lot of people have paid a lot of foreign taxes.
Yeah, that is correct. The truly wealthy may have, and,
Right.
and that's for whom this tax was intended. So there are two factors happening here. One says your standard deduction, although it's large, is static. You're not getting benefit of the credits, and so therefore I worked up a vastly oversimplified
let's
example.
hear the bad news.
But the bad news is, let's pretend you are a family of four. Your earnings are $100,000, and let's pretend that you
And
live
that's together.
combined.
Okay.
Mom and Dad both make $50,000 apiece. Let's say you don't own a home, so you don't have a mortgage interest. You don't make any charitable contributions. Plain vanilla tax return. W-2s, $100,000, 2 children, children aren't in college. Under the old alternative minimum system that was put in place in the 1960s, you're allowed to deduct $45,000 from your income. And then you multiply the balance by 26%. If that system were in effect right now,
Which
this
would be
family,
about 14 or something.
$14,000 roughly, very good. If that system were in effect right now, you would owe about an additional $2,500 in tax than you would if you calculated your tax,
Wow.
claiming a deduction for your dependents, claiming your standard deduction. And so what Congress did for, I believe, every year since perhaps 2002, Congress said, well, we're going to do two things. We're going to increase the standard deduction amount from $45,000, which is what it was set in 1969, to, it's, I believe, $66,250 for 2007. And we're going to let you take advantage of all those credits that I just talked about.
Oh.
So they've taken care of both parts of the problem. And so now this family of four that I'm talking about, instead of owing 14-something, instead of having a tax liability of something like $14,000, their tax is closer to $12,000 or $11,500, something like that.
Which pretty much took that away.
Right, yes. And if they had credits, let's say these children were in college, they get their full credits under the regular system, which you don't get under the alternative minimum system. It's a big deal. It's a very big deal.
Is this going to expire, or is this going to change, or we don't know what's going to
We don't know. We don't know.
So it could be 2,500 more, or it could...
It could be.
But for 2007...
For 2007, we're okay.
Okay.
For 2008, we don't know, because every year since about 2002 or 2003, Congress has passed a one-year temporary fix.
Okay.
And this year's temporary fix for 2007, I believe, wasn't passed till after Thanksgiving, which is why there's a delay in filing some forms, because they have alternative minimum implications. And so IRS isn't accepting all tax forms till February 11th.
I guess we could wonder why they don't just fix that permanently.
We could, but I'm a tax preparer, not a politician, and this is a political, it's really a political issue, because it becomes a question of, if we make a change to the alternative minimum system and every family who makes $100,000 is going to owe
Another $2,500?
Another $2,500, you have to find that revenue from someplace. And that's
Right.
what our politicians discuss for us in Washington.
Okay.
Whereas if we enact another patch and extend these higher standard deductions for another year, we're losing the revenue that we might have received had we not extended this patch. And where's that revenue coming from? And that's a political
And that could be
issue.
significant if you're hitting
Absolutely.
families that make that much.
That's right. And that, again, for any of your viewers, vastly oversimplified. You need to look at your own situation. There are situations where it could be worse based on any credits that you might be entitled to. I mean,
Okay.
this family I left the credits out of. It's pretty remarkable what a difference this makes. And it's just one of those little problems out there that really has to be reckoned with, at least from my point of view.
And I think there are quite a few problems, but
yeah.
I guess there's not much we can do other than call our legislator and see if we can get some help.
And get some help, and sort of be aware of it.
Right.
You know, I mean, once the patch has been passed, you're not conscious of the fact that you might have owed $2,500 in additional tax.
Right.
You know, because you
didn't
don't-
lose anything.
Yeah, you didn't notice it, you didn't see it, but it's becoming a bigger and bigger problem every year. So there've been a lot of, you know,
Now, I think
questions.
dividends, there were some changes there, and almost everybody in some way gets some dividends.
get some kind of dividends. We are now in the ending years of the 2001 tax cuts, and these cuts were phased in. What are we calling this decade from 2001 to 2010? The aughts, the O's?
I'm always worried about that.
I don't know. Whatever this decade is called,
Right.
there were a number of tax provisions that were built in. Provisions took place, expired, credits changed, and then since they were passed in 2001, they've been tinkered with. One that I believe is going to sunset in 2008 gives a preference to dividend income that you receive.
Now, what do you mean a preference?
The W-2 income, the wage income that you and I earn from our employer is
Right.
taxed at whatever rate our tax bracket is, 15%, 25%, typically those are the two biggest brackets. If you and I have qualifying dividends from stock that we own in various companies, those dividends are taxed at a preferential rate, meaning if you're in a 15% bracket, you'll pay tax at a rate of 5% on those dividends.
Okay, so
if you're in a 25% bracket, you'll be taxed at 15%. And if you're in a 25% bracket or higher, the maximum tax is 15%.
Okay.
So somebody with $1,000 worth of dividends saves maybe $100, which is not bad. Somebody with $10,000 worth of dividends saves $1,000.
I think most of us don't like writing checks.
That's right. And that is something that's going to, I believe, sunset in 2008.
Was it reduced for 2007, or it just goes away next year?
It goes away next.
Okay.
Right now, it goes away. But
Okay.
stay tuned. You know.
Okay.
And there is a special provision for long-term capital gain treatment for 2008 that sort of ties to the dividends. If you happen to be in the 10 or 15% bracket, which are the two lowest brackets, and you have long-term capital gains, you will owe no tax on those long-term gains.
Okay. So that encourages
that's a good thing. That encourages
people to save.
That encourages people to save, or it encourages people who are lower income to sell securities, take their gains, and not pay any tax on them.
Okay.
It also encouraged, and this has been nipped in the bud, it also encouraged people to consider putting assets in their children's name so that the child could sell the asset at the lower bracket, but that's not going to happen.
Okay.
Okay, you're not going to be able to take advantage of this rule by putting assets in your child's.
Was that a change, or it's just a ruling?
In part a change, and no, actually that was a change. Minor children are subject to something called a Kiddie Tax, and it says the first, this year I think it's $750 of income is tax-free.
Okay.
The next $750 is taxed at the child's rate.
I see.
Anything over that is taxed at the parent's rate. And the kiddie tax used to apply to children under 14.
You're really talking about babysitting and things like that.
Oh no, I'm talking about a young child who has an investment account set up
see.
by grandma or grandpa.
Of
okay?
course, yeah.
Or grandma and grandpa get stock
So we're talking about
certificates.
dividends.
The child owns Disney stock that's very popular. Lots of grandparents buy.
Yeah, because you want to teach them something about investments.
Right. And so stock is held in the child's name, the dividends are earned, and if the child sells securities, I mean, the parent is doing the selling, they pay less tax than the parents do. But the rules on the kiddie tax have changed. The age for the child is now 18 instead of 14, and next year it's going to either age 23 or 24. So you can't put assets into your college.
I suppose some children became much wealthier after this.
They sure did. Yeah. Children, I mean, getting deductions for children and using children to help you in the tax code is something that people have used for a long time. In, I think it was 1987 was the first year that you were required to put a Social Security number down for a dependent.
Okay.
Thousands of children disappeared.
Disappeared?
Yes.
It's a sad year.
Yes, thousands of children disappeared because parents were claiming children that, well, there are stories abound about, claiming the dog and the cat and the pets and children who've grown up and left the house and, well, that ended when you had to put a Social Security number down.
Creative it was.
Very creative, yes, yes.
Now, what about itemized deductions? That's something that people would like to do if they can, if it helps them get above that standard deduction.
Absolutely.
What might have changed for us this year?
For itemized deductions, the standard deduction for a married couple is $10,700 this year. For a single individual, it's half of that, which would be $5,350. Changes, probably the biggest change for itemized deductions is the ability to deduct cash contributions made to charities. Now you need some kind of documentation from the charity that you made the contribution. The money that I have lots of people who throw money in the basket at church.
Right.
And it's so many dollars a week, and you used to be allowed to keep a contemporaneous record of the amount you contributed. Now if you contribute cash, you must have a receipt from the charity for it, or a cash receipt is also considered a bank record or a credit card record. A check would be.
Okay.
But no more $5 bills.
Okay.
Okay, or $100 bills. Or you need, if you want to donate cash to a charity, you need something in writing to prove that you made that donation.
Well, that's a change.
That is a change that's new this year.
And that may cause the amount of charitable
donations to go down. Yes, just the way the children went down in 1987.
Right, because I remember all of these things that I think I might have done.
Yes, yeah. So that's a change for itemized deductions for this year. And of course, the fact that the standard deduction goes up a little bit every year, fewer people are able to itemize just because they pay off their mortgage and they no longer have mortgage interest. Right. You're still allowed to take a deduction, and we are in the second year of this, I believe the second, maybe the third. If your sales tax, which you calculate by using an IRS-approved table, is greater than the amount of income tax that you paid, you're allowed to deduct the sales tax if it's higher.
That doesn't seem quite likely. Does that happen very often?
It happens.
Or maybe buying a car.
Buying a car, because a car is like a one-time purchase, and you can take that in addition to all your other expenses. Where we see it quite a bit, actually, is for people who are retired, who pay little or no tax to New York State, and therefore their sales tax is going to be greater than the income tax that they pay, and often these people have significant medical expenses, so they're itemizing their deductions anyhow. Sometimes they donate generously to charity. So this gives them a little extra write-off that they can take on their Schedule A by being able to take a deduction for sales tax instead of state income taxes paid. And that helps a little bit.
Now, if you buy a car and you pay the sales tax, obviously you have a record of that.
Yes.
But you said you use a table for the miscellaneous kind of a thing. So how do you reconcile the two situations?
Well, IRS gives you a little chart, and it says, look up your income, look up the number of people in the household, look up your sales tax, and in Albany County it's 8%. And then it says, based on those factors, we calculate that we, being Internal Revenue Service, this is how much tax that you would have spent just by being a modern, normal American consumer. Okay.
If you're a good consumer.
If you're a good consumer, and you usually have to be a good consumer. If, in addition, you purchased a car, you may add that on.
Okay.
If you are a compulsive record keeper, and you can show that you paid more in sales tax than the table amount, you may take that. And the year that we moved, I was spending money at a rate that I thought I'd never spend money again, at least until my children went to college.
Right, because if you buy a house and you have to buy furniture.
Furniture and things. Anyhow, I kept track of everything. And I had the proverbial shoebox full of receipts, added them up at the end of the year. It was within $25 of the table amount.
Oh my gosh.
And I believe it was less. And I threw away the box and I said, I'm never going to do this again.
Wow. So, yeah.
So I mean, no, that's not to say that it wouldn't work for other people, but
Right.
you
If
know.
you're an ingenue and you have a lot of clothes to buy for the
Perhaps.
balls, maybe.
Yes,
But,
perhaps. And maybe if you're buying more expensive things than I was buying at that point in my life, maybe
but
it would
still,
make a
it seemed
difference.
to you that you had actually spent more than normal.
Right,
And
and
so
I didn't,
it
I
sounds
came
like they're-
close,
Right.
but, you know, I never bothered again. And it used to be, I mean, back in those days, I mean, this is over 20 years ago, you used to be able to take both the sales tax and the income tax.
So
And
probably most
now-
people just now take,
most people take the income tax unless they're seniors, they're a very likely category to take the sales tax.
okay,
And if somebody bought a car,
Right.
sometimes that will
Push
push you
it
over
over.
the top, yeah.
okay.
So. that's-
Education has always been a confusing thing for me. I went back and got a degree, and
Okay,
I
and you
I
missed the
interpreted it all
education
in my
credits?
No, I didn't, but I didn't know for sure if I was doing it right. I just did it.
Okay. There are 2 credits and 1 deduction that are in effect now, and these are all part of this 2001 tax cuts, which will all sunset, I believe, in 2010 unless something is done to change them. One credit is called the HOPE credit. It applies to the first 2 years post-secondary. It gives you a deduction of it gives you a credit, excuse me, not a deduction, of up to $1,650.
A credit.
A credit,
And
yes.
say the number again?
A credit of up to $1,650 on tuition expenses of $2,200. You basically get 100% of the first $1,100 and half
I
of
see.
the next $1,100.
Okay.
That wonderful credit. I mean, $1,650 is just subtracted from your income. That is on a per student basis. So if you have the good fortune of having triplets in college at the same time,
Okay.
okay,
You can really deduct.
each student gets this credit for the first 2 years. Once you get past the first 2 years post-secondary, there's something called a lifetime learning credit. And this is on a per tax return basis.
So if you're working on your master's and
If you're working on your master's, the lifetime learning credit would apply to you. The tuition, the maximum amount of tuition you can pay is $10,000, and you're allowed to take a deduction of 20% of that number.
Okay.
And that's on a per tax return basis, so you can never take more than $2,000 for a lifetime learning credit. And that's good for anybody. I mean, if you go back and get another master's, there are some income restrictions on this. If your income is above a certain amount, you're not allowed to take the credit. If it's below a certain amount, you take it in full. If it's in between, it phases
I
out.
see.
And for joint returns, the maximum is somewhere between $114,000, $115,000, and for all other returns, it's probably between $55,000 and $58,000.
So there's not really a marriage penalty there.
Well, no. Well, there is and there isn't. I personally find that for somebody who is a head of household, somebody's raising children as a single parent, they use the same number that a single individual does, and it kind of hurts for them because if you're a single parent and you have a child in college,
It hurts much worse.
It hurts.
So
It hurts
really,
quite a bit.
yeah.
Okay, but that individual might be eligible to take a deduction of up to $4,000 right off the front page of the tax return. And depending on what your tax bracket is, probably 25%.
So they would get some back.
They'd get some back,
otherwise.
yeah. I mean, 25% of 4,000 is 1,000, so this tuition would at least save you $1,000 in taxes. So that is, and that taking the deduction, this year is going to require completion, this year being 2007, is going to require completion of a new form because we think what was happening is that people were taking the deduction and the credit, and you can't double dip. If you take the credit on, say, $10,000 worth of tuition, you can't then turn around and say, well, I spent $15,000, so, you know, I mean, you
Kind of taking it on the same money twice.
right, you can't do, so this form now asks you for the social security number of the student And that's a way of checking that to make sure you're not taking it in two
Okay.
places. And most commercial software takes this into account. I think it was mostly people doing tax returns by hand and mailing them in. And so there's now a form for that. So,
more
so
forms.
you have to report, yes, another form to.
Yeah, we
to
have
put
a
that in.
rack of forms downstairs, and we try to have as many forms as we can, but
Oh, I'm going to send people up here.
well, there are hundreds here, and then of course
Okay.
online they can
Yes.
print anything.
Yeah. There's a lot of really good reference material available online, both at the IRS website and the New York State website.
Right.
And if they don't send instruction booklets the way they used to, but if you go online and you even look just at the beginning pages of the instruction booklets where it says what's new,
Okay.
that's very helpful.
Right.
It lets you know if you're forgetting anything or if there's something that maybe you did forget last year. There are some energy credits that people were not aware of.
So at least if it's complicated, you can ask about it.
Exactly.
And
exactly.
maybe as a tax preparer, you might not know that they have it, and they might not even think of.
Right.
So some of these
Well,
things can get
some of these
complicated.
things, you have to think, you have to remember to ask things. New York State has a new credit that's available for firefighters, volunteer firefighters, and volunteer ambulance personnel. So part of my interview is now, gee, do you or your wife, if you're married, volunteer for an ambulance corps?
Right.
Or are you a volunteer fireman?
But even with 200 questions, there might be some
Right.
situation you might not know
Yeah.
about. So,
And a lot of times the
although I'm sure you've read the front of that book, so you
Oh
know
yes.
all those
Oh,
things.
I read it all the time because I mean I try to keep up to date, but there's a lot that's out there, and things change, and it's just a good way to say, hey, did I remember that? Did I read it?
Yeah, you don't want to miss that.
Yeah, you don't want to miss it, and a lot of these sort of occupation specific. There's a $250 deduction that teachers get for buying classroom supplies. And that's another one of these scheduled to phase out things. Most people who have occupation-specific deductions or credits are aware of them because they're talked about at the workplace.
Okay.
And they come in
So
and
that
say,
helps.
hey, I heard about this. Yeah.
Right.
So they help us.
Good.
That's a good thing, too.
Well, let's look at energy in our closing. We have a few
Sure.
more minutes.
Yep, okay.
What's anything good in energy? We seem to lose more deductions as we need more of them.
Yes. Energy is another one of those credits that is subject to this phase out. I mean, it's scheduled to expire. There is the most common, I would say, energy improvements are for things like windows and storm doors and insulation, things like that. It disappoints a lot of people, and that's the only way I can describe it, when they learn that their maximum, first, your maximum lifetime deduction for these things, the maximum credit is $500. That's the first
Yeah,
thing.
if you want to put in a $20,000 solar system.
Right, and now a solar system is different.
Oh.
This $500 limitation is on windows, doors, insulation,
Uh-huh.
and some energy efficient appliances. Windows, the credit is limited to $200. And that means you look at the windows that you put in, multiply by 10%, and the most you can take is $200. So if you
Okay.
put in $2,000 worth of windows, you've maxed out on your lifetime
Okay.
credit for windows.
But that, if it was continuing, maybe you could at least do downstairs this year.
Well, but let's say you did it in 2006, and you did $3,000 worth of windows, and you got your $200 credit. You're done.
Okay.
No more.
Oh, you're
Okay.
done.
As somebody said, I could spend $2,000 on one window, much less my whole house. I mean,
Wow.
people spend like $7,000 or $8,000 put windows in on their house, and I don't mean to minimize the credit. Every dollar is valuable, but it's kind of disappointing sometimes for people who've just
you're
spent.
looking for an offset. You're looking for a payback. So
Right. Yeah. They just spent $7,000 on windows, and they get a credit of $200. And then you do the insulation and some of those things, and a lot of that is what uses up the other $300 for the lifetime credit. I discovered last year that some energy efficient burners and heating equipment,
Okay.
there are credits for them. They are very specific. They need to meet Energy Star standards. Most of them don't.
Oh.
And you would go to your energy company, the contractor that installs the system. They'd be able to tell you. I had a couple clients, I sent them back to the installer, and I said, I need to know if this meets the requirement, and it has to meet certain mechanical specifications, and most of the ones I talked to did not.
Oh, that's too bad.
It is, it is, because people get excited about this, and then somebody like me says, well, we need to know. I believe New York State, just talking about energy credits, I believe they still have a credit for replacing an old oil tank. They give you a little rebate on that.
Too many people.
Not too many people would have that, but, and then there are many, and I would not even try to talk about these off the top of my head because they're many, and again, they're very specific. State and federal credits for solar power and photovoltaics. And
So you might need a consultant when you get there.
well, and if you're, and again, let's say you're...
NYSERDA might be a good phone call for that.
Would be a good phone call for that. If you're working with a builder, you're planning to build a house, and you're installing one of these systems, they absolutely know all about this.
Oh, okay.
Because,
part of their offer.
the system is going to cost $20,000, and by the way, you're going to get a credit of X dollars.
Mm-hmm.
And it is a credit. It is,
and
that's wonderful, yes, because it reduces your tax, not your income.
That's good.
So those are some things, and I would encourage anybody who's thinking about them. These might also fall into that provision where we don't know what's going to happen to them after 2008. And that's an issue for a lot of the things I've talked about today.
I guess it seems like the most, I know we're not in an advice mode, but it seems like you really need to just forget about the future because it could go this way, it could go that way, and evaluate the deal on its own merits. And then like any other time, don't look at the TV set that you just bought every 5 minutes for the next 3 years and see if you bought the right one.
Right. And that is, I think that is, we're not in advice mode, but that is very good advice. There are so many decisions that people make based on what the tax consequence is going to be. And people will say to me, well, should I do this now or then based on the taxes? And I...
Get out your crystal ball. And
and most of the time I say to them, you need to make this decision based on whether it's the right decision for you or not. Is it the right investment? Is it the right time to buy your house or sell your house? Are you going to get a deal? If you're going to get a deal if you buy now or sell now. Try to make your decision without considering the tax consequences because we really don't know what they're going to be.
Right.
And we do an awful lot of thinking and planning based on how's this going to affect my taxes, which is not a terrible thing. That's my job.
Well, right. Yeah, there you go.
That's my job.
I think I may have asked you this the last time you were here. I want to do it again anyway.
Sure.
Record keeping. It's early in the year. Everybody's focused on 2007.
Yes.
But by the time they start focusing on 2008, it's going to be 2009.
Right.
So maybe some advice on what should they do, and maybe it's not too late. Is there anything to save now for the next year? What any records they should be thinking about?
I would hope that most of the people who have employee business expenses or small businesses of their own have some method so that they are keeping track of their expenses currently, because that is, I think, the most difficult thing about owning your own business or having copious records that you have to keep. And it's now 2008, and I have clients who are contemplating going through a bin of receipts and checks and sorting it all out and trying to put it into some kind of order because I'm certainly not going to be able to figure out their bookkeeping system when everything is thrown into a big box. If you are in that position, try to get into the habit of doing this at least monthly so that you sort and organize and put all your records into some kind of order, at least on a monthly basis. It's a whole lot easier at the end of the year to have 12 numbers to add up than to have a year's worth of...
And you probably remember a little better what you've done.
Absolutely. And that's another thing that's important. If you keep records on a contemporaneous basis, you have a better handle on what you're doing. I think you remember better. Because if IRS is going to ask about your tax return, it may be 2 years after you actually collected all this. And as time goes by, it gets harder to remember what you did. I don't know what I was doing 2 years ago at a particular time. The better your record keeping is, the better shape your records are in if you do have to present them for an audit.
And it could be worth money.
It absolutely could be, because the position IRS takes is you took a deduction on your tax return, prove it.
Right.
Okay, show me that you spent the money. And I don't mean to make them sound like ogres, because I don't believe that. I mean, they're people with a job, but when they say prove it, they mean we need to see a canceled check, we need to see a receipted bill, we need to see that you actually paid it. Because just because you own something doesn't mean that you bought it. You know, we believe that you own it, but prove to me that you're the one that paid the money for it, that somebody just didn't give it to you.
So you still need the paperwork.
You still need the paperwork. And this may seem like a really minor thing, but wow, if you have receipts on all that thermal paper, oh my goodness, do something to get it into another format, because after a couple of years, that thermal paper fades, and it's next to impossible if you can read it at all. You know, and that's something, if you get it into another format and you do it on a timely basis, you won't be sitting there 3 years later saying, you know, what does that say? You know, like trying to, and that creates a real problem for IRS as well.
That's like good advice.
Yeah, I mean, and it's, you know, we get that everywhere in receipts, and, well, not everywhere. There are places that have printers, but that stuff, it's deadly.
Until they're all
like,
gone.
You know, you look at it and you say, like, what is that number?
I've seen it. Yeah.
Yeah. So, but record keeping, the more contemporaneous your record keeping is, the better. And if you have a business, you need to be sure that you have that information for at least 3 years. 5 is better. Let's pretend for a moment, as one of my clients did, that you had a falling out with your business partner and in disgust just pitched all your records. Big mistake. When he was audited 1.5 years later, he had no documentation for his expenses.
So I see penalty in his life.
Well, actually, he did not have a penalty. IRS was very understanding. They really don't penalize you if you do something kind of dumb like that. Okay, all right. He explained what had happened. They understood. He was able to reconstruct some of it. He couldn't reconstruct everything because the documentation was just, he was just disgusted and he threw it all away. So he owed more tax. I mean, that was the penalty. And I put the penalty in quotes. He owed more tax and he owed some interest on the money. But he had not understated his tax by such a large number that if you understate by a large enough number, they have a substantial underpayment of tax penalty. He did not run afoul of that.
Okay.
And they, you know, they do understand people do these things. And he, of course, was kicking himself, and his wife was less charitable than that. Right. Okay, but you know, you really need, and sometimes people will be at my desk, and I can tell they're estimating, and you know, we talk about having mileage logs and mileage records, and I always say, you need to do this right now, and I mean right now, write down what your mileage is or what these things are that we're talking about. And sometimes we do them at the desk, because I guarantee you that in 2 years, if you need to reconstruct this, you won't remember. And it's much easier to do it when it happens than it is to have to reconstruct it later on.
I have one more question.
Mm-hmm.
I'm going to push us over the time just
Okay.
a little bit. But
Okay.
at the library, I said we have tax forms.
Sure.
We have a flood of people later in the year looking for an extension.
Okay. Oh, sure.
Now,
do you give them the form?
we give them the form. It's not our business to say you can't have the form, but
right.
Any advice for those people? What does it mean to get an extension?
Less than people think. An extension is just an extension of time to file. It is not an extension of time to pay. So that means, and very often, it's April 10th, and somebody says, well, I waited to the very end because I was afraid I was going to owe money and I don't have it, and I wanted to wait to the very end. Well, that's fine. You owe $10,000, Mr. Client. Well, can we file an extension for that? We can certainly file an extension, but you still have to pay your $10,000 on time.
And if
Okay.
you don't...
And if you don't, you're subject to interest. You are subject to late filing or late payment penalties. And these penalties are real. Sometimes they're not enforced quite as much as they are other times, but if you owe enough money, yes, they are absolutely enforced. And I tell people, I counsel people, it is much better to file your tax return and file your tax return on time. And if you owe some money, if you owe more money than you can pay, at least send your return with some payment. Then you have filed on time, because the failure to file penalty is 5% per month of what you owe, up to 25%. So if you say, whoa, I can't pay this, and 2 months go by, you owe 10% of the tax
More,
as a penalty.
right. And
So, we encourage people.
You'd be better off borrowing the money.
File your tax return on time.
Right.
And you can set up a payment plan with Internal Revenue Service. You can borrow money if need be. But filing an extension is fine, but it doesn't eliminate the need.
It better be in a case where you're getting some back.
Right. And then it's fine. Then it's automatic. You don't have to worry about it. And I guess that sort of leads to a point that I often make with people. If you think you're going to owe, please don't wait till April to do this, because one, perhaps you're mistaken and perhaps you're getting money back. And if you're getting money back, why wait till April? And if you think you're going to owe, why not come in a little bit earlier? Because maybe between the time you prepare your return and the time that you actually file, you'll be able to get some money together. Coming in later isn't going to change.
And know what you need.
And maybe you're thinking you're going to owe thousands of dollars, and for whatever reason it turns out you owe $2,000. And maybe you can't pay the $2,000 any more than you could pay the $10,000, but if you know about it in March, well, maybe you can get half of the money together.
Right.
So that's something too. And it's always a pleasure to do a tax return for somebody in April who thinks they owe thousands, and you tell them they owe a few hundred or they're getting a refund. That doesn't happen that often. But if you think you're going to owe, don't wait to the end.
Happy client.
Yeah, don't wait to the end. Find out earlier so that you can start planning, because it's expensive to file late because of penalties, and it's expensive to owe Internal Revenue Service money, because in addition to the late filing penalty, there's a late payment penalty that's 0.5% a month.
It's like a bank, a credit card.
Worse.
They hit you. Oh.
Well, because every month, in addition to the interest that you're paying,
You're getting a penalty.
0.5% gets added on. And if you do that for a year, you've effectively added 6% to the cost of your money.
So, not good.
It's expensive. So.
Well, Patricia, thank you again.
Well, thank you, Richard. Pleasure to be here.
Great.
Thank you.
Yeah, I want to thank Patricia Catchpole from H&R Block on Wolf Road, and wish you a happy tax season and a profitable year, and hope you have a good week. Take care. Bye.
Welcome to Channel 17, the Town of Colonie Government Channel.